I was talking to a young investor last week, sharp guy, maybe 30 years old, and he told me something that's been eating at him for months. He said, Warren, I want to invest in companies that do good in the world, but everyone tells me I'll have to accept lower returns. I'm trying to build wealth for my family, but I also don't want to fund things that keep me up at night. And I looked at him and I smiled. Because that assumption that you have to choose between your values and your returns, that's one of the most expensive lies in investing today. Here's what most people don't realize. The idea that ethical investing means lower returns? It's not just wrong, it's backwards. And I'm going to show you the numbers that prove it. See, there's this study from Morgan Stanley. They analyzed more than 11,000 mutual funds over 7 years, from 2004 to 2018. You know what they found? Sustainable equity funds met or exceeded the returns of traditional funds 64%. Of the time? 64%. Now you might be thinking, well, Warren, that's just one study. Maybe they cherry-picked the data. Fair enough. Let's look at another one. Morningstar did their own research in 2020, tracking sustainable funds during one of the worst market crashes we've seen, the COVID-19 pandemic. While the S&P 500 dropped about 34% from its February peak to its March bottom, the average sustainable equity fund, it dropped only 20%. Think about that for a second. When the world was falling apart, when everyone was panicking, the companies that treated their employees well, that had strong governance, that weren't cutting corners on safety or environmental practices, those companies held up better. Why? Because they'd built something real, something that doesn't crumble the first time the wind blows hard. Let me show you what this means in real dollars, because I think in dollars, not percentages. Say you invested $100,000 in January 2015, split it two ways, half in a traditional S&P 500 index fund, half in something like the Vanguard ESG US stock ETF. By the end of 2023, that traditional investment would have grown to about $227,000. Not bad. That's roughly a 127% return over 8 years. The ESG portfolio? It would have grown to approximately $234,000. That's a 134% return. Now that's a $7,000 difference on a $100,000 investment. You didn't sacrifice returns, you actually made more money. And here's the kicker. You slept better at night. This is where it gets really interesting, because we're not just talking about numbers on a screen. We're talking about a fundamental shift in how we think about business. For decades, people operated under this assumption that companies had to choose, either maximize profits or do the right thing. Milton Friedman said, the only social responsibility of business is to increase profits. But you know what? Milton was wrong about that one. And the market's been proving him wrong for the last 15 years. See, when a company treats its workers well, those workers are more productive. When a company doesn't pollute, it doesn't get hit with billion-dollar lawsuits down the road. When a company has diverse leadership, it makes better decisions because it's got more perspectives at the table. These aren't feel-good talking points. These are competitive advantages. Think of it like maintaining a car. You can skip the oil changes, ignore that check engine light, keep driving on bald tires. And yeah, short-term, you'll save some money. But long-term? That engine's going to seize up. You're going to get stranded on the side of the road. And the repair bill is going to be a whole lot more than those oil changes would have cost you. Companies work the same way. You can cut corners on worker safety, dump chemicals in the river, bribe officials, cook the books. And maybe for a quarter or two, your profit margins look great. But eventually, the bill comes due. Now you might be thinking, okay, Warren, but what about oil companies? What about tobacco? Those stocks have made people rich for decades. You're not wrong, they have. But let me ask you something. When you're building wealth, are you trying to get rich quick, or are you trying to build something that lasts? Because here's the thing about industries that harm people. Eventually, the world catches up. Tobacco companies looked like unstoppable cash machines in the 1970s. Then came the lawsuits, the regulations, the cultural shift. ExxonMobil was the most valuable company in the world in 2008. Today, it's not even in the top 20. Meanwhile, companies like Microsoft, Apple, Nvidia, they're not perfect, but they've built their wealth on innovation, not exploitation. And look where they are. But here's what most people still don't understand about ethical investing. It's not about avoiding the bad stuff. That's defense. The real opportunity, the thing that can actually make you wealthy, is finding the companies that are solving the world's biggest problems. Clean energy, water purification, sustainable agriculture, healthcare access, education technology. These aren't charity cases. These are trillion-dollar markets. You know how much money is going to be made solving climate change? The International Energy Agency estimates that reaching net zero emissions will require about $4 trillion in energy sector investments every year through 2030. $4 trillion every year. Now you can sit on the sidelines with your old energy stocks, watching them slowly decline. Or you can invest in the companies building solar panels, electric vehicles, grid storage, carbon capture. Which sounds like a better bet for the next 30 years. See, this is where the math and the psychology come together beautifully. When you invest in companies that align with your values, you're more likely to hold them during downturns. You're not going to panic sell at the bottom because you actually believe in what they're doing. And that patience, that's what builds real wealth. I've said this for years. The stock market is a device for transferring money from the impatient to the patient. When you invest in companies you believe in, truly believe in, you become one of the patient ones. There was a study from Calvert Research in 2019 that found investors in sustainable funds were 25% less likely to sell during market volatility compared to traditional fund investors. That behavioral difference alone can be worth 2 to 3% in annual returns over time because you're not constantly buying high and selling low based on fear. So what do you actually do with this information? First, stop thinking about ethical investing as a sacrifice. That mindset is costing you money. Second, if you're just starting out, look at broad ESG index funds. Vanguard, BlackRock, State Street, they all offer them now. Fees are low, around 0.1 to 0.2% annually. You're not paying some premium for doing the right thing. Third, understand what ESG actually means. Environmental, social governance. It's not about being perfect. No company is perfect. It's about whether a company is managing these risks and opportunities intelligently. A company that's reducing its carbon footprint isn't doing it to save the polar bears. I mean, that's nice, but that's not why investors care. They're doing it because carbon is going to be expensive, either through taxes, regulations, or physical damage from climate change. Companies that prepare for that now will have lower costs later. That's just smart business. Fourth, and this is important, don't let perfect be the enemy of good. I see people get paralyzed because they can't find the perfectly ethical investment. So they end up doing nothing, sitting in cash, earning zero, while inflation eats away their purchasing power. That's not noble. That's just expensive. I remember when Charlie Munger and I were looking at investing in BYD, the Chinese electric vehicle and battery company, back in 2008. Some people thought we were crazy. Warren, you've never invested in car companies. You always said they were terrible businesses. And I said, I'm not investing in a car company. I'm investing in the future of transportation. We put in $230 million at its peak. That stake was worth over $8 billion. Now it's come down some, But we're still up about 3,000%. Not bad for doing the right thing, huh? But here's the part that really gets me excited. We're still early. ESG investing only accounts for about 33% of total assets under management globally. That means 2/3 of the money out there is still being invested the old way, just chasing returns without thinking about sustainability. As that shifts, and it is shifting, I guarantee you, the companies that have been building sustainable business models are going to see their valuations increase. It's supply and demand, plain and simple. When more money chases ethical companies, their stock prices go up. You want to be there before that happens, not after. Look, I'm 94 years old. I've been doing this for more than 70 years, and I can tell you, the best investments I ever made weren't just about the numbers. They were about businesses I understood, run by people I trusted, selling products that made the world a little bit better. That formula worked when I bought C's Candies in 1962. And it works today when you're buying shares in companies developing clean energy or improving healthcare or treating their workers with dignity. The difference is today you've got more opportunities to invest this way than I ever did. You don't have to compromise your values to build wealth. You never did. You just had to stop believing the people who told you that you did. So here's my challenge to you. Take one step today. Open that ESG fund. Research one sustainable company. Read the sustainability report of something you already own. Because the best time to start investing ethically was 20 years ago. The second best time is right now. Your future self, and maybe the world your grandkids inherit, will thank you for it.